Hello there. I want to welcome you once again to my YouTube channel, Mastering Accounting with F2 Angel. Thank you so much for your support. Thanks for your likes, your subscriptions, your comments, and your suggestions. It's been so massive. It's been super good. Thank you so much. I appreciate everything. And thanks for making this possible. So we are going to continue from where we stopped during our previous section. So for the previous section or the previous weeks, we started a series on asset standards, and then we had gone into IAS 2, accounting for inventory, and then we dealt with the part 1 aspect of IAS 16. And today we are going to conclude on the standard, IAS 16, the part 2 aspect of the standard. So just a quick recap. Last week's discussion, we had a very detailed discussion on IAS 16. So we spoke much about the cost components, we spoke about the measurement criterials, and then we went on to solve examples involving key concepts. And then there was detailed explanation given for various terminologies that are important to we understanding the concept of IAS 16. So today we will just proceed from where we stopped during our previous section. So in our previous discussion, we solved the first example. So today we are going to solve another question. And then the same principle will be applied, but just that this is more of an upgrade from the previous section. Okay, so let's proceed. So we have two items, A and B. Okay, and then item A have an estimated useful life to be 8 years, whilst item B has an estimated useful life to be 6 years. And then the figures are in millions, so I'll be saying them out in thousands because we have 1,000 at the top of our figures. Okay, so item A had cost 240,000, whilst item B had cost $120,000. So the accumulated depreciation at that period for item A for 2 years has an amount of $60,000, whilst item B has an amount of $40,000, giving us a current amount as at 31st March 2012 to be $180,000 for item A, whilst item B was valued as $80,000. So as at 1st April 2012, we had done some revaluation. Revaluation was covered in our previous video. So if you miss out on the part 1 aspect of the standard, please revisit. It's very, very, very much important. And then for you understanding this standard, it is important that you get yourself to master the concept that were discussed in the part 1 aspects of the standard. So please revisit the video, okay? Just in case if you've forgotten or if you need to remember certain concepts, you can go back to watching the videos, right? So we have a revised remaining useful life to be 5 years for item A and then also 5 years for item B. And subsequently, we had incurred an expenditure as at 1st April 2013 for item B, giving us an amount of $14,400, but no such expenditure had incurred for item A. We spoke about the sort of cost that can be or sort of expenditure that can be embedded or that can be capitalized as part of the asset. Those were discussed in our previous video. So That means that this very expenditure had met some of these conditions. That's why we have to add them to the revised costs for item B. So at 31st March 2014, item A was still in use, but item B was sold on that date for $17 million. OT Limited does not make an annual transfer from its revaluation surplus to retained earnings in respect of excess depreciation. So we have two requirements, and the first one says that we should prepare an extract from OT Limited statement of profit or loss for the year ended 31st March 2013 and 2014 in respect of charges or expenses related to property, plant, and equipment. And then the second requirement says that we should prepare an extract from OT Limited statement of financial position as at 31st March 2013 and 2014 for the property, plant, and equipment and the revaluation surplus. So when you talk about an extract, it means that you are preparing portion, or you are preparing a portion out of a whole. So when you see extract, sometimes in our exams you'll be required to prepare an extract of something. It means that you do know how to prepare the full statement, but just portion of it. Okay? Yeah. So now we will go through the workings before we reflect the figures onto our financial statement as required by us to do. So remember, we said something in our previous discussion that at the date of revaluation, depreciation can be calculated as the revalue amount over the remaining useful life of the asset, right? So as at 31st March 2013, we have a revalue amount to be $160,000, and the remaining useful life, as it was reported, was 5 years, giving us a total depreciation of $32,000 for item A. Remember, we have two items in stock, and then item B had a revalue of amount of $112,000 with a remaining useful life of 5 years. When you divide 112,000 by 5, punch it on your calculator to verify the figures. So this will give us 22,400. In order to ascertain our total depreciation for 2013, we sum up the two figures, giving us $54,400. So now we will also need to calculate depreciation for as at 31st March. Remember, we are preparing it for two periods, 2013 and 2014. So as at 31st March 2014, our item A still had the value of 160,000 divided by 5 years, giving us the same 32,000. But remember, for item B, we had a capitalized expenditure that was given to us as an amount of 14,400. Okay, so we have to value the assets before we had incurred that very expenditure to know what the revised cost to be. Should we embed that figure into the cost of the asset at that point in time? So the revalue amount that we had previously was 112,000, and then depreciation gave us 22,400. So when you punch your calculator, 112,000 minus 22,400, this will give you 89,600, and then you add the 14,400. When you do that, you arrive at the figure 104,000. So the 104,000 will now become our revised cost for item B. So now it has become necessary, or it has made a way now for us to be able to calculate for our depreciation on item B. So the revised cost now, which we now consider as our revalue amount, is 104,000. Remember, from the previous time that we had done the revaluation, we had a remaining useful life of 5 years. From 1st April 2013 to 31st March 2014, we had an additional expired life, so we have to deduct that from the remaining useful life that was given to us. That's how come we have 5 minus 1 giving us 4 years. So when we divide the 104,000 by the 4 years, we are going to get 26,000. So to ascertain our total depreciation as at 31st March 2014, we are going to add the two figures, the 32,000 and the 26,000, and this will give us a total of 58,000. Okay. Now, I told you earlier that whenever we are introduced to revaluation, we should know that it will become necessary for us to calculate for either a revaluation gain or a revaluation loss as a result of the revaluation that may have taken place. So for item A, we know that it was revalued at 160,000 and item B was revalued as 112,000. Remember what we said in our previous discussion on revaluation gain or a loss. For us to be able to ascertain a revaluation gain or a loss means that we have to know what the carrying amount of the asset is at that point in time, and then we will compare that to the revalue amount given to us. Any difference that will arise from that will result into either a gain or a loss. In this instance, item A had a carrying amount to be 180,000. So we're saying that the carrying amount, that is the value in our books, is more than what the item was revalued at. So if that happens, we are getting a loss of $20,000. Lucky for us, item B was revalued upwards, meaning that it was revalued at 112,000, but the carrying amount of the item in our books was worth $80,000, giving us a revaluation gain of $32,000. In our previous discussion, I dealt with on how to treat both revaluation gain and revaluation losses. That's why it's very important that you revisit the part 1 aspect of this discussion for you to better appreciate the concepts under discussion, right? So now we saw that in 2014, item A was still in use, but then item B was sold out for $70,000. Once there was a sale, we talked about derecognition in our previous discussion, right? So once item A was sold, we then have to calculate for any gain or loss on disposal, or any gain or loss arising out of the sale. Okay, so to do that, we need to know what the value of the asset was at the date of sale, and then how much the asset was sold for us to be able to calculate for any gain or loss on disposal. So at the date of the sale, or at the period of sale, the item had a cost of 104,000. We've gone through the calculation of the 104,000, and then the depreciation for that item at that period was calculated as $26,000. So this gave us a carrying amount of $78,000. And even though the item was worth $78,000, we've seen that we have disposed the asset off for $70,000, giving us a loss of 8,000, meaning that we've lost on the sale. We had loss on the sale, basically. Right. So, and then because our requirement require that and we prepare the financial statement for March 2013 and 2014, it became necessary, or it has become necessary, for us to ascertain the carrying amounts of both items for the two periods. So as at 2013, 31st March, item A was revalued at 160,000, and then we had calculated our depreciation to be 32,000 for item A. Remember, in our previous workings, okay? So this gave us a carrying amount for item A to be $128,000 when we subtract the $32,000 from the $160,000. This will give us a total of $128,000. And then for item B, it was revalued at 112,000, and then we had an accumulated depreciation at that period to be 22,400. So when you subtract the depreciation from the revalue amount, you will arrive at 89,600, right? So when you sum up both figures, you have a total carrying amount to be 217,600, and then the total depreciation to be 54,400. That's at 31st March 2013. So when we come to 2014, we remember that item B was derecognized. We were told in the question that item A was still in use, but item B was disposed of, meaning that we had derecognized it in our books. Remember last week we spoke briefly about derecognition, right? So we had revalued item A to be 160,000, and then we had to calculate for our depreciation, which was the 160,000 over 5 years. So remember, we are in 2014. So from 2012 to 2013 is 1 year. And then 1st April 2013 to 31st March 2014 is 2 years. So we multiply by 2 years in order to ascertain our accumulated depreciation as at that period. So this will give us a total of $64,000. So when we subtract the $64,000 from the 160,000, this will give us a difference of $96,000. So it means that our carrying amount as at 31st March 2014 is $96,000. Okay. So now we will reflect the figures in our income statement and then our statement of financial position. Okay, so the total, so now we'll first of all work out our income statement. Okay, so the total depreciation for item A and item B as at 2013 that we calculated. You can refer to working one actually. So this gave us a total of 54,400 for 2013, and in 2014 this gave us a total of $58,000 for depreciation. And then our profit or loss on disposal. So we saw that we had disposed of item B in 2014. So we sold it at 70,000 instead of 78,000, and then this gave us a loss of 8,000. So that's how we got the loss. And then we have done some revaluation, and then we saw that in our previous discussion we explained why revaluation loss are recorded in the profit and loss, and why revaluation gain are recorded in other comprehensive income under revaluation gain. So we had a revaluation loss to be $20,000, and then the revaluation gain, which is now recorded under other comprehensive income, to be $32,000. Okay. So now the statement of financial position has a 31st March for 2013 and 2014. The carrying amount for property, plant, and equipment has at 2013, so you can refer to working 5 and 6, was valued at $217,600, and then in 2014 these were valued at $96,000. Remember, in 2014 item B was no longer in use, we had disposed it of. Okay, so and then the revaluation reserve that we had initially recorded. So we said in our previous discussion that it can be classified under equity, under the heading revaluation reserves, if you remember or if you record. So we had recorded a gain of $32,000. So that brings us to the end of our requirement as far as this question is concerned. So now we are going to go into calculating, or how to calculate depreciation using the various methods. There are times when you will be required in a question to calculate depreciation based on the straight line method, or reducing balance method, or the machine hour. So I saw it necessary that we do a recap of how to calculate depreciation under these three methods. So using the straight line method, I have a question here that I want us to go through for us to be able to appreciate on how to, work out depreciation using the straight line method. So LEN company purchased a machine for $10,000 with a useful life of 5 years and a residual value of $2,000. So now we said the last time that depreciation is equal to cost minus residual value over the useful life of the assets. So in this instance, our depreciation will be 10,000 minus 2,000 over 5 years, giving us an annual depreciation of $1,600 per year. So we have 5 years, so from year 1 to year 5. And then watch something. The cost recorded here, it is fixed throughout the years. It's a straight line method. So for us to appreciate the real method, let us take a key look at how the cost components are being demonstrated and how the accumulated depreciation also being demonstrated. Okay, so the item had cost 10,000, and then our annual depreciation that we calculated initially is 1,600, and then we have a fair idea of how to come about the carrying amount. So it is the 10,000 minus the 1,600, giving us $8,400. And then for year 2, the cost still stands as 10,000, but now accumulated depreciation, we are in the second year, which means that periodically our depreciation had cost us 1,600. So if we are in year 2, it will be 1,600 times 2, which will now give us 3,200. So when we subtract the 3,200 from the 10,000, this will give us a carrying amount of 6,800. So that's how come we have this, 6,800 over here. Okay, so we will continue to year 3. In year 3, we had a cost of 10,000, and then our accumulated depreciation, which should be $1,600 multiplied by 3 years, giving us a total of $4,800. So when we subtract the 4,800 from the 10,000, we will arrive at 5,200. Okay, so in year 4, our accumulated depreciation will now be the 1,600 multiplied by 4, giving us a total of 6,400. So when we subtract the 6,400 from the 10,000, we will arrive at 3,600. Okay, so that becomes our carrying amount at the end of year 4. So in year 5, the cost still stands at 10,000, but now our accumulated depreciation is 1,006 multiplied by 5, giving us 8,000, and then when we subtract, we will arrive at $2,000. Okay, so this gives us the demonstration of depreciation using the straight line method. So we will proceed to the next method, which is the reducing balance method. So we continue with our question now. It says that L Linen Company purchased a machine for $10,000 with a useful life of 5 years and a residual value of $2,000. The depreciation rate is 20%. So we've been introduced to something new, and that is the depreciation rate that has been given to us. So for year 1, we know that the item had a cost of 10,000. To be able to ascertain our depreciation, we will multiply the 10,000 by the rate of depreciation, giving us 2,200. So when we subtract the 2,200 from the 10,000, we will arrive at 8,000, meaning that at the end of the period, the carrying amount for the assets will now be $8,000, reducing balance method. So as the years progress, or as we progress in the years, the net book value of the asset will be reducing. It will be reducing by the depreciation that we had already incurred. Okay, so that brings about reducing balance method. So in year 2, we have our opening net book value to be $8,000. So now our current depreciation will be calculated based on this 8,000. So 20% multiplied by 8,000, this will give us $1,600. So when we subtract the $1,600 from the 8,000, this will give us a carrying amount at the end of the period to be 6,400. So in the third year, actually, the cost now become 6,400. So we will multiply the depreciation based on that. So when we multiply 20% by 6,400, we will arrive at 1,280. In order for us to ascertain the carrying amount of our asset, we need to subtract that figure from 6,400, giving us a value of 5,120 for the carrying amount. So in the fourth year, the 5,120 will now be considered as the cost of the asset. So when we multiply 20% by 5,120, we will arrive at 1024 as our depreciation for that period. So when you subtract the 1024 from 5120, we will arrive at 4096. So in the fifth year, we have a balance brought figure to be 4096. So when we multiply 20% of that, we will arrive at 819. And when we subtract 819 from 4096, we will arrive at 3277. So this brings us to the end of the discussion on reducing balance method. So we proceed on the last method, which is the machine hour. So L. Company purchased a machine for $10,000 with a useful life of 5,000 machine hours and a residual value of 2,000. So the formula for depreciation in this instance doesn't change at all. So we have the cost minus the residual value over the useful life in hours. Remember, we are looking at machine hours. So instead of useful life, now we have in hours, okay? So we were given the cost to be 10,000, and then we subtract our residual value of 2,000 over 5,000, which is the total machine hours, and this gives us $1.60 per machine hour. So we are looking for per unit, okay, per unit. So it means that each hour will cost 1.6. That's what it means. So we are assuming that within the year we operate 1,000 hours for year one, okay? So in order for us to get the monetary value of the 1,000 hours, we will multiply the $1.60 by the 1,000 hours, which will give us the total value of $1,600. And in order for us to ascertain the current value of this, or the current amount, we will subtract the 1,600 from the $10,000, giving us $8,400. So this brings us to the end of discussion as far as the various methods of depreciation is concerned. There are other methods, but for the sake of this discussion, we will limit ourselves to just these three methods. We can also have the sum of year digits method, but we are going to restrict ourselves to these three for now. So there were some suggestions given in the comment section, and someone has suggested that at the end of each section there should be a trial question. Okay, so this question here for L-N Limited has been given to us for us to try our hands on it. So when you are able to try your hands on it, you can send me the solution to angelkamara51@gmail.com, ANGELKAMARA51@gmail.com. So you can solve it and then send it to me. I can go through and also give you feedback on your solution. Thank you so much, guys. It's been wonderful with you, and I'm so much grateful for your time, and I'm so grateful for your efforts in trying to understand the standard. It is one step at a time, so the goal here is to improve with time. Thank you, and kindly keep your suggestions and your comments. Your suggestion, your comment, they should keep coming. Okay, I really do appreciate everything, and please do not forget to subscribe, like and share this video. Thank you so much and have a good day.